When it comes to investing, it's always important to be ready when opportunities persist. Sometimes we see those opportunities coming. Many times we don't. And it's very important for you to build a watch list of stocks. Perform your due diligence ahead of time so that you are comfortable buying a stock and you know at what levels you want to buy those particular stocks. And in today's video, we're going to take a look at 4 high quality companies high on my buy list. I don't own any of these stocks right now, but if their stock prices fell, which as a long-term investor, I hope they do, I would gladly be buying into them. But before we take a look at these 4 stocks, do me a huge favor. Click that like button down below as that shows your appreciation for the videos that I put out. It also helps with the algorithm to push these videos to a larger audience. And if you haven't done so, make sure you subscribe to the channel as well so you're notified anytime we drop new content. With that being said, let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. The stock market, particularly the technology sector, has seen some volatility kind of creep in, as we have had our single worst day since December of 2023, but is more pain in store. And again, in today's video, we're going to be taking a look at 4 stocks high on my buy list, which means I'm not particularly crazy about the prices they are selling at today, but if they do in fact fall, I'm going to be ready. And as a reminder, all 4 of these stocks are not currently within my portfolio. So let's begin with the first stock on our list, which is Advanced Micro Devices, otherwise known as AMD. This is a semiconductor stock that I have owned in the past, and I've made really good money with it, particularly with wheel strategy as it pertains to options. I was able to buy the shares low and sell them much, much higher. However, with a lot of this AI stuff going on and a refresh in the computer industry, this is a stock I'm looking to get back into. AMD shares currently trade with a market cap of $224 billion, and over the past 12 months, shares are up 22%. Looking out a little bit further, over the past 5 years, shares of AMD have climbed more than 300%. AMD reached a high of $227 per share back in March, but since then, the stock has retreated nearly 40%. And you know me by now, I love buying high-quality stocks on pullbacks. AMD shares are now trading at levels last seen in December of 2023. However, the company continues to expand and build upon it. We're seeing revenues climb. In the latest earnings reports, revenues have increased from $16.4 billion just a few years ago to more than $22.8 billion over the trailing 12 months. With all of the AI capabilities being put into computers and with consumers looking to take advantage of those efficiencies they can incorporate into their everyday work lives, I expect a computer refresh cycle to take place, which will largely benefit a company like AMD. Look here at the growth that analysts are expecting over the course of the next 3 years. It averages out to 40% per year in terms of EPS over that period. With EPS expectations of $3.49 per share, that has shares trading at a 39.6 times multiple and a 25 times multiple using next year's estimates. Both of those give the company a PEG ratio of 1 or lower, indicating great value. However, given the concerns around technology as a whole, it would not surprise me to see the shares move lower. Looking at the charts here, the next level of support for shares of AMD will be around $130, and then after that, closer to $120. So $120 would be the level I would look to add this particular stock to my portfolio. And instead of just waiting around to see if that stock comes down, I'm going to be utilizing options by selling cash secured puts, generating income while I wait for a stock to come down to a price I'm willing to buy it at. So if you're looking for more AI exposure in a stock not named NVIDIA, definitely take a closer look at AMD. And that leads us to our second stock on the list, which is Merck, stock ticker MRK. Merck is a much different approach. AMD, high growth and technology. Merck, pharmaceutical, and the defensive side of things with healthcare. So if in fact things get worse before they get better within the stock market, a lot of folks will rotate out of those high growth sectors and over into more defensive sectors like healthcare. Regardless, Merck is a company that can work in any economic backdrop. The company currently has a market cap of $319 billion, and over the past 12 months, shares are up 17%. Zooming out, over the past 5 years, shares of MRK are up 61%. Merck, just like AMD, is another company that's going to be reporting their latest earnings results in the coming days. So I'm definitely going to take a wait and see approach before making any sorts of decisions. Keytruda is far and away the company's largest blockbuster drug, but at the same time, the company is very robust, very diversified. However, Keytruda, being the leader, saw their sales grow more than 20% in the latest quarter to nearly $7 billion. They do have many other up-and-coming drugs as well, with a loaded pipeline. And in the latest quarter, management increased their guidance, something we love to see as investors. So looking at expectations for the next 3 years after a down year in 2023 in terms of earnings, we could see EPS growing by 9% if we take out 2023, followed by 17% growth in 2025, 10% in the following year. That averages out to 12% earnings growth over the next 3 years. Using next year's earnings expectations, shares of Merck currently trade at 12.6 times. Historically, shares have traded closer to 15.3 times. So we are already in a good spot from a PE perspective, a valuation perspective. However, other valuation metrics don't look as intriguing. And if you're interested in learning how I value stocks and I go through my entire valuation and analyzing checklist, then definitely check out my 6-week investing accelerator course, where we can work one-on-one, developing a personalized strategy and action plan, and also go through my entire checklist showing exactly how I analyze companies and how I value companies before looking to add them to my portfolio. There'll be a link down in the description below. So back to Merck, if we're looking here, you can see that the 200-day moving average is around $122 per share, with another layer of support below that at $120. So these are the areas that I'm looking to potentially add shares of Merck to my portfolio. But first and foremost, I want to see how earnings come out prior to making any decisions. And that leads us to the third stock on our list, which is Salesforce, stock ticker CRM. Salesforce is a Dow Jones component. It is a software company operating out of the technology sector. It has had a rough year in 2024. It has seen slowing growth. It's still growing at a solid rate, just at the slowest rate that investors have seen, giving them reasons to be concerned. Shares hit a 2024 low of around $215 per share, but they have crawled back, gaining back some of those losses to now trading closer to $260 per share. Shares of CRM currently have a market cap of $249 billion. Over the past 12 months, shares are up 14%, and over the past 5 years, up about 61%. Pretty close to that of Merck. As I mentioned, the company's latest earnings report wasn't all that great. That slowing growth really concerned investors moving forward, and being a large component of the Dow Jones Industrial, we saw that entire index sell off at the same time. However, that slowing growth, I believe, is more of a blip in the radar, something that can be fixed and will be fixed when it comes to Salesforce. They are building a lot of efficiencies for companies, and many companies out there, as we go through another subcycle, as the economy strengthens again, where companies will be looking to invest in making their processes a lot more efficient. How do they do that? By utilizing a lot of tools that Salesforce has. Salesforce has been investing heavily into AI, as has many other companies, and they recently partnered with Workday to develop an AI-powered assistant to handle many HR-related tasks. This could be a big growth driver for both companies as more and more companies look to automate more tasks. Looking here, you can see that analysts are looking for double-digit EPS growth, averaging around 15% per year over the next 3 years. Using next 12-month earnings, shares of CRM currently trade at a forward PE multiple of 23.9 times. For comparable purposes, this is a stock that has traded around 42.9 times over the past 5 years and 38 times over the past 3 years. This is a sizable discount to those, but one that deservedly came down given the slowing growth. This is the company that was growing at a much faster clip in recent years, so the decline in earnings is warranted. So what are the next levels of support from a technical perspective? Looking here, you could see that first level of support is going to be around $245 per share. If it breaks that, that'll be around $229 per share next, falling down to $212, which was how far the stock plunged after its latest earnings report. In terms of looking to buy, this is a stock that looks rather intriguing right now, but I would like to see it pull back, and given the concerns on the technology sector as a whole or the market as a whole, I would like to first see those shares come down below $250 per share before I truly consider starting to look to buy shares of CRM for my portfolio. And that leads us to stock number 4, which is Meta Platforms, stock ticker META. This is a stock that needs no introduction at all. There's already been movies and documentaries shown about the creation of Meta Platforms, which was formerly Facebook, created by Mark Zuckerberg and his friends within their dorm room. So what is the intrigue, you might ask, when it comes to investing in Meta Platforms? Well, for starters, I believe we're going to see a bounce back in digital advertising. And number 2, I know you probably haven't heard this at all, but there's a presidential election coming at the end of this year. And in fact, we have a new candidate on the ballot. So what does a new candidate this late need to do? They have a lot of catching up to do. What do you need to do to catch up? You need a lot of advertising. Where are you likely going to advertise? How about the likes of Facebook, Instagram, or even across the web as well, which is why I also like the likes of Alphabet, my largest individual holding. Meta Platforms currently has a market cap of $1.1 trillion, easily the largest company on our list today. Over the past 12 months, shares are up 55%. And over the past 5 years, shares are up 125%. When it comes to earnings growth, Meta Platforms isn't growing as fast as it once did. But when you have those type of growth figures year in and year out, those become really tough comparables to keep up, unless you're, of course, Nvidia. For Meta, you can see that analysts are still calling for a good amount of growth moving forward, averaging around 21% growth per year moving forward. Using next year's earnings, this is a Mag 7 stock that you can acquire for below 20 times PE. For a stock that has historically traded closer to 25 times over the past 5 years, but closer to 21 times over the past 3 years. So the discount does not look as great. This stock is one that does have some work to do before I would consider jumping in. I would like to see that stock pull back to below $400 or around $400 per share, which is where we saw it plunge to after that latest earnings report. And what happened during that report? We saw them beat on earnings. However, investing isn't about as much as what you did for me. It's more about what you're going to do for me. And the guidance they gave, they brought down revenue guidance and they increased capital expenditures. 2 things going in the wrong direction. So there we just looked at 4 completely different companies. 4 companies I don't own any of right now, but 4 companies on my watch list. And I will be ready when those opportunities, if those opportunities persist. Down in the comments section below, let me know what you think of these 4 companies. Do you own any of these 4 companies? And what levels would you be willing to buy these 4 companies at? And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.